Tuesday, February 17th, 2026. Today, the market closed up just a teeny bit, 0.1%. And I hope everyone had a great 3-day weekend. But the market was just a little flat today, a little bit up. And so I want to pull the lens back and talk about where we are overall, just as the market. And we've talked about this very narrow band that we've been in since October. We've been bumping our head up against the 7,000 range on the S&P 500, and we haven't broken through it. That said, on the downside, we drop maybe 2.5%, and then all those dips are being bought. So there's a really narrow range that we're bouncing between, and that can't continue forever. Eventually, we have to resolve either to the upside or to the downside. And so, um, the last 2 weeks, we've had back-to-back weekly losses. That's just a short-term, indicator of where we are the last couple of weeks. And I thought about it, and I thought about the stoplight analogy that every morning when I get up and I erase that whiteboard in my mind that we've talked about, I think about where the market is overall. And is it a green light, like we're in a secular bull market, the economy has great numbers, everything is, very positive sentiment on Wall Street, everything yellow light caution, red light is, sit back, protect yourself, protect your money. Right now, I definitely feel like we're in a yellow light situation. And I'll explain, where I'm getting all of that. So along with that, I want to talk about that's number one every day is where are we overall? Right now, I wake up, it's yellow light. Number two, trading disciplines, okay? And I've learned this throughout many, many years of success and failure, trial and error. And like I was telling someone this weekend, man, if you want to learn your lessons well, then invest your own money and don't talk about it, do it and learn those lessons because you'll never forget. I promise you that. So another rule that I follow is definitely not to chase. Don't chase the market. And I've learned this the hard way. Everyone has, that you have to be honest. And when I'm looking at a stock or the overall market or a sector, energy, whatever, as I have to be honest and not chase. And by not chase, I ask myself, has the move already happened? So I'm watching a stock and I've been waiting for it and waiting for it with discipline. And then all of a sudden it takes off without me. And I've got my short-term bias to it and I want to go get it because I've been waiting patiently, but has the move already happened? Short, long-term, whatever it is. Because when people chase, oftentimes I have found that that doesn't work out well. For example, right now, we've got a shift from money in technology and artificial intelligence. It's sort of moving into this physical world of stuff and things and, real companies that do things such as Caterpillar, such as Walmart. And I bring both of those up because both of those stocks have had incredible runs. But I ask myself, is that move already done or am I chasing them? And without going into the specifics, just look at the charts of Caterpillar, CAT is the ticker, Walmart, WMT. Look at the moves that those have and ask yourself what they do. Has Caterpillar really sold that many more backhoes and generators, or is the stock really being bid up on price and not necessarily fundamentals? So has the move already happened? In those, they have to me, and I'm definitely not chasing them in regardless of the fact that those are amazing companies. And so a third one I want to talk about, and we've talked about this last week, and that is price action. The action of the price is going to tell you the mindset of the investors in the market and the market overall. For example, this earnings season, which started about 5 weeks ago, we are about 75%, 80% of the way through it. Three-quarters of the companies out there beat on revenue, three-quarters of them beat on earnings, and guidance has been raised. And in that time, in those 5 weeks, even though we've had 75% of the companies, just do great and report great numbers, in those 5 weeks, the S&P is down 1.75%. And so that to me is the price action, especially when you have contradictory news and price action. Good news, bad price action. That's the disconnect that gives me a yellow light caution. And then just briefly overall, the S&P right now is trading at about 22 times earnings overall for the whole S&P 500 companies. But historically, it's more like 18%, a little over 18%. So it is trading at a 20% or so premium to its historic average. Now, I've heard people talk about, well, that's the earnings expectations and the overall value of the market should go up because of technology and yada yada. But I'm sorry, that's exactly why things have been falling recently, is because of the doubt in all the spending and the AI and technology. So just remember that versus history, the S&P right now is at trading at about a 20% premium to its multiple. So for example, today as well, I just want to point this out. These are anecdotal, but we had some of those fundamental brick and mortar companies reporting, and these reflect on the economy, to me, the overall economy, the health of the US and what's happening. For example, the company Herc, the company Builders First Source, also Vulcan Materials. They make aggregate and concrete and supply. Those are all building companies that go into infrastructure and construction. And these companies all had disappointing earnings. And so again, this is just one day, it's just anecdotal. But when you look out for the next 6-12 months, where that spending is and what it says about infrastructure and growth overall for the economy, for the country, that is, something that caught my eye today. So let me tell you about my feel, okay, of what's going on too. And that is that we've got a rotation going from technology and artificial intelligence. There's doubt, and that is rolling out of the cash is being sold out of there, and it's being put into this rotation into other areas, such as those industrial plays we talked about, Caterpillar and the consumer discretionary like Walmart. But it's also gone into consumer staples. We talked about that last week. And but to me, that rotation is a little too calculated. It makes a little too much sense in terms of, oh, we've been buying the dip for the entire last year. So right now I'm out of technology, but I have to put my money somewhere else. No, you don't. You and I know that. But overall, the market, I believe, is thinking that it has to be invested. It has to be risk on. So when it sells off technology, it doesn't think about playing it safe with its cash or going into something that yields like a money market or bonds or anything like that. It thinks, where else do I need to put this? And that rotation, like I said, is just feeling a little bit too calculated, a little bit too cute. And so that's a feel that I have. And you know, the Mag 7, the biggest technology, Google Alphabet, we've talked about all this, the Mag 7 is down year to date, 7.5% in 2026. It's down 7.5%. And so, and yet the market is really, is not down by any stretch that far. And so when you've got those huge companies that comprise so much of that money and underpinning that have dropped that much, and you see all that money rotating into much smaller sectors and much smaller stocks, and that's holding the market up, that to me is a little bit shaky. And like I said before, a little bit too, makes too much, too cute. So again, like I said in the beginning, for me, it's about being honest with myself and not being hopeful, trying to take my biases of whatever I want to happen and put them to the side and say, okay, I'm going to be honest, has the move already happened? Um, Watching software, for example, we've talked in the last 2 weeks. You've seen me testing in and out, going in and out of a couple of names like ServiceNow or Microsoft to really see if they've bottomed out after this extreme sell-off in software. And I did get out eventually of those because the price action was still poor and they continue to roll over and they don't have upside momentum. So being honest, no. The price action is not good in software, even though I continue to believe and think that this is overdone, the selling is overdone in software. It doesn't matter. The market is telling me something else, and that just means that now is not the right time. But I'm definitely keeping my eye on that. And also that as we talked about, the AI fear, and that hasn't been resolved, yet as well. People haven't answered those questions. And then I just put a note here that I always remind myself that the easiest money that I've made and people can make is when a stock goes from absolutely horrible to just bad, you know? In other words, you watch it fall and you don't try to catch that falling knife, as they say, as it's going down, but wait until it bottoms and makes a solid bottom and starts heading back up. You don't try to grab the very bottom, but once it has turned and the price action has improved and you watch the volumes of trade, the trading that goes on, and you can get the average daily volume for every stock and compare it. You want to see big volumes and improving price and fundamentals and sentiment. Once that trade has been made, that turn has been made, then the trade from when it's just horrible and way down until, back up until it's, just bad. Some good money to be made there. So look, I want to know also, I've had some great questions and I want to hear more. I want to hear what you think. I want to hear what you are seeing out there. And I've heard from some great investors and from their own views. And so anyhow, drop me a line down below. You've also got my email, wallstreetwman@gmail. And I want to know what you're seeing. And so let's talk about it. Let's have a dialogue because we are what makes the market. You, me, everyone. We are the buyers and sellers. And so I want to hear all viewpoints as always. So that's it for today's show. And this is what one other thing, and that is that I want to tell you that 3/4 of the time I am looking at the risks. And just like when at the end of the show, like I say, with your money, protect it, preserve it, then make it. Okay. 2 out of 3 of those may be looked at, viewed as negative, but I promise you the best money I have made in the market is when I'm saving money by being cautious. Okay. And I can't stress that enough. So they say a penny saved is a penny earned. I say a penny saved is a dollar earned in this case. So anyhow, always looking at the risks. And that is not to say that I'm negative overall because I'm positive overall. I am net bullish overall, but I am just extra, extra cautious with my cash, with my hard-earned money before investing it. And I hope you are too. So there you go. And I look forward to hearing from everyone and I'll talk to you tomorrow. Have a great one, everyone.